Robert from Infonomics joining us in, brother. How you doing?
Good. Good morning.
Good morning. All right, so we have a lot to talk about. I want to get started, though, with just what's going on in Venezuela, man. I know there's politics that can be spoken on this very simply, very easily, but I want us to get into the actual economics of the situation. What are the ripple effects going to be you're seeing, brother?
Yeah, so going back to 2003, which is kind of the most analogous situation, I guess you could say,
Yeah.
analog. Um, a lot of folks. So to start, let's start from kind of bird's eye view. Iraq and Venezuela, both very kind of authoritarian sort of regime, both of them not well received by the West, both of them very oil rich. Back then in 2003, Iraq was number 2 in the world. Venezuela now, if you listen to the 300 billion barrel reserve estimate, which really I saw tracked back to the Castro regime. If you listen, go by that, then Venezuela being one of the top in terms of oil reserves. You would have expected oil prices, in my opinion, to go down. And a lot of people are very bearish on oil right now. I'm actually getting increasingly bullish. And I think that looking back at 2003 kind of just cemented that view. So back in 2003, inflation was about 3%, just where it is today. Real GDP was about 2%, just where it is today. And following the 2003 invasion of Iraq, we saw oil go from $25 per barrel all the way up to 130. Now, granted, Venezuela and Iraq, two totally different geographies, two totally different political organization, right? Like, are we going to see that level of insurgency from Venezuelans? Probably not. But again, I think it's an interesting analog because of the number of similarities. Look, the 300 billion barrels that people are estimating Venezuela might have are going to take years, if not close to a decade, to actually bring online. And so the short-term impact could actually be a pop in oil, which is what we're seeing today.
When you say a pop in oil, we're talking about supply or we're talking about price?
Price.
Okay.
So oil gapped, futures gap down Sunday evening, yesterday afternoon. Futures gap down, and we've reversed all of that. Oil is actually up by almost 2%.
Okay. I don't get this. So explain this to me like I'm a 5-year-old, because it looks like investors should be looking at impending oversupply of oil.
Well, we already some, oil folks would argue we already have an oversupply.
Okay.
But, how much of that is priced in? Number one, and number two, how much of the arrangement that Venezuela might have had with China, right? How much of that is at play too? Where China now, where they might have had kind of a backroom deal with Venezuela, how much now? Because China was one of the major buyers from Venezuela of their oil. So how much now does China have to go into the actual open market for their energy needs? And
Right.
China is not blessed like the U.S. They're much more akin to Europe or Japan, where they have to import a lot of their energy. Now they're building tons of coal power plants, and the China story, in my view, I think China is on the upswing. If you look at their rates, that their bond yields indicate that they are probably starting to reaccelerate, much as I would argue the U.S. is. So I think part of it is going to be a global kind of reacceleration of growth. And part of it is going to be, there could be some issues with the Venezuelan supply if there's acts of sabotage, if there is, a kind of paramilitary sort of insurgency that starts to develop. You could see sabotage to some of that supply.
Well, obviously, we're talking a little bit out of our depths too, because we're economics guys.
Yeah, I'm not an oil guy.
Yeah, and now
right
we're getting
off the
into
bat, I'm not an oil guy.
geopolitics and probably not the first and only regime change we're going to see this year. They're already
Hopefully.
talking about Cuba.
I know.
We already have Iran just knocking on the door of wanting it next. It's not funny. It's difficult to follow. There's lots of ripples to track, but oil is so important to the backbone of international economics that it has to get talked about. You just brought up another graph. Talk to me about this.
Yeah, well, also just kind of the correlation between inflation and the price of oil, as we can see here. I'll take the 10-year off. The price of oil is critical when it comes to inflation, which we know here domestically from a political angle here in the U.S. This is one of those things that President Trump is struggling with, I guess you could say, affordability and cost of living, inflation, those sort of things. So, keeping a low oil price is in his political interest. And I would also say, to the point about Iran, part of what we could be seeing in oil right now is, the market starting to get worried about, if they're going to intervene here in Venezuela, basically go in and kidnap, a leader of a country, maybe some degree of risk premium needs to get priced in regarding
So
Iran.
you're talking about the different, but you're getting into now socioeconomics, which is all on economics, really is a form of socioeconomics, where we have the math of saying, okay, there's going to be an abundance of oil, possibly pricing that into the market. But at the same time, we have a little bit of, I don't know what the word to say other than just volatility in seeing how quickly and rashly we can take matters into our own hands. And you're saying that investors are going to be a bit more wary to invest in American investments when they don't know what our next move is, pretty much, right?
Yeah, I mean, if you look at what's getting bid, it's gold. So gold.
That usually tells us exactly what we're saying, that investors
Yep.
are seeking other investments other than the dollar.
Yeah, so gold is up 2.5% off Friday's close. So that's a significant move in gold. Silver up 5.3%. So yeah, I think that look, here in the U.S., what is getting bid? It's mainly the Mag 7 up 1.3%. So some amount of that kind of, I think, return to, I guess you could call it, the 2023 trade, which was the primary vehicle to express kind of a bullish view was Mag 7, because they were pretty much insulated from a lot of the other risk. That trade is starting to come back, it looks like, with the Mag 7 up 1.3%. Yeah, I think that we're probably going into a kind of global reacceleration when it comes to growth. And that's kind of a corollary, I guess you could say. So some amount of broadening out when it comes to Mag 7 versus, say, IWM or RSP, which is the equal weight S&P.
You got to slow down, Mr. Letterman. So
RSP,
let's explain what the Mag 7 is for those that don't know that one as well.
So Mag 7, that's Nvidia, Microsoft, Apple, the $1 trillion companies right now, kind of really propping up the vast majority of the stock market. The Nvidia, Microsoft, Apple. You're gonna make me space out here early in the morning.
The AI tech stocks, pretty much.
The AI tech stocks. And so, yeah, that's Mag 7. That was what was doing really well in 23, 24. Really, like, the only thing that was keeping the S&P 500 green during those 2 years was the Mag 7. And it's constantly getting shifted around, right? Like, I've heard people removing companies. Tesla was in there, but I think that some people have removed them. So yeah,
the big one used to be the big one used to be FANG, wasn't it?
FANG, yeah. Or was FANG
Facebook, Apple, Amazon, Netflix, Google.
Netflix, yep. Yeah, so RSP is the equal weight S&P 500. So instead of giving a weighting in the index to how large is the company and therefore how much of an impact is that company going to have on the overall index, instead of doing it by market cap, which heavily weights the S&P 500, say, the SPY, that heavily weights to, NVIDIA. How is NVIDIA doing? How is Microsoft doing? Rather than how is the real economy doing?
Actual economy.
Yeah. RSP tries to do the opposite of that, which is instead of giving the weighting by market cap, give the weighting by, equal to all components.
Equally sounds confusing as well as makes sense. So let's move on to something I just have a personal question about, and I know you have a good answer for. What's going on with silver? Because you started mentioning gold. You mentioned silver kind of went back up in the last few days as we reopened this morning. What's going on, though, with the fact that different countries are seemingly trading at different rates above spot? And it looks like in China and Japan specifically, correct me if I'm wrong, we're seeing over $100 an ounce is what they're pricing silver at. While meanwhile, we're still in the 70s. So please explain this to me like I'm stupid, because I feel like I am. Is this the paper versus physical that people have been talking about?
Yeah, to some degree. It's kind of in the broader backdrop, I guess you could say, of this de-dollarization trade, I guess you could call it. The debasement trade is a corollary to that de-dollarization trade. Here this chart from Bloomberg shows the dollar's role in global FX reserves. So if you're China, if you're Japan, and you run a trade surplus or a current account surplus, your country's accumulating back during the gold standard, your country would be accumulating gold, right? Because more gold was flowing into your country rather than flowing out, because you were selling more to the rest of the world than you were buying from them. So therefore, on a net basis, gold flowed into your country. That's kind of how it used to work back during the gold standard. Now with the dollar kind of in the recent setup, I guess, under the dollar, that is not how it worked. We would run very large trade deficits, meaning that we were sending dollars out to China, to Japan, to Malaysia, a lot of emerging market countries in Asia, and then they were reinvesting those dollars back into U.S. Treasuries.
Sure.
So as that flywheel, which worked really well for the U.S., and it kept interest rates quite low here in the U.S. because bond price inverse to the yield. So as just over the past 4 quarters, the U.S. has run a $1.3 trillion current account deficit just over the past 12 months.
Just 1.3 trillion? That's light.
So it's huge. Huge amount of inflow into financial assets here in the U.S., and mainly that was U.S. Treasuries. Well, that is starting to kind of get eroded. So this chart from Bloomberg shows so if you're China, if you're Japan, and you're selling way more to the rest of the world than you're buying, your country's accumulating assets. Well, where do those assets get put? That is what we're looking at with the chart from Bloomberg. It used to be, a large percentage would get put into U.S. Treasuries. That is shifting in favor of gold. And this is a trend that's been going on for at least 10, 15 years. It is not a new thing. A lot of people are talking about it and making it appear to be a new thing, but is not a new phenomenon.
So let me slow you down there. For anyone scrolling by that just heard what you said and it just doesn't understand why that is, why is it that somewhere between 10 to 15 years ago, kind of a la past the great financial crisis, did we start to see this shift in terms of countries going after holding more precious metal like gold versus treasuries, like you said, which is essentially just our debt, bonds, correct?
Yeah. So, 2022 was a turning point, I would say. In 2022, we told the world, it used to be that, again, the U.S., the arrangement we had with the rest of the world was, hey, we will hollow out our country. We will ship our factories to you. We'll send you dollars, right? You make this stuff and then reinvest the dollars that we send you back into
America.
Yeah, back into our stock market, into our U.S. debt, and that that did not change in recent past, right? Like what caused the peak back here in foreign held debt as a share of total government debt, which I think is the way to look at it, not foreign held debt on its own, nominal, because that is a parabola, right? Our debt is going up and to the right relentlessly. So foreign held debt is going to go up and to the right. But what you want to see is foreign held debt. Is it increasing at the same rate that our total debt is increasing?
And
well,
can you
that
explain,
peaked out.
Yeah, can you explain the colors too on which one's which here? So
Oh,
the white
yeah,
line looks
yeah.
parabolic, green's dropping down.
That's gold.
That makes sense. Okay,
I'll take gold off. So this is showing foreign held debt as a share of total government debt.
Okay.
And at the peak here in 2012, about 34% of our total debt outstanding, 34% was held by foreign investors. That number now is just 24%. So what this is showing is that our total debt is increasing at a faster rate than foreign held debt. Meaning, yeah, foreigners are buying our debt, but not at the, we are increasing our total debt faster than they are buying
faster
our debt.
than other countries are willing to supply us. Yeah. Okay. And when you say buying our debt, explain that to me like I'm 10. What does that mean, buying our debt?
So buying U.S. Treasuries. And this coincided, by the way, with QE3. So after 2008, there were multiple QE programs, QE1, which was, during kind of the height of the GFC. That was right away, QE1. And then there were these kind of...
QE2 was a lot more shorter term, right?
Unnecessary, right? Like QE3 really wasn't necessary. If you look at real GDP, the economy was not doing great, but it was starting to come back. QE3 was the peak in foreign held debt. So, whether or not that's a coincidence, I'm not sure. I don't think it is. But foreigners on a net basis,
you're making.
They as soon as QE3, which again really was not necessary. Foreigners started to pick up on the fact that, oh, wow, they're just going to print money to oblivion, right? Because QE is the Fed literally printing money to buy long-dated securities in the form of mortgage-backed U.S. Treasuries. They saw that signal of QE3, and that just so happened to be the peak in foreign held debt as a share of total government debt. So ever since then, foreigners, they've been buying our debt. They've been buying U.S. Treasuries, but they have not been buying at the same rate. They are not increasing their holdings at the same rate that we are increasing our debt. And that is a trend that, again, goes back, is not a new phenomenon, that diversification away from the U.S. Treasury started. I mean, again, it kind of, according to that chart that we were looking at from Bloomberg, this and IMF has made multiple articles about this. The dollar share of those global savings, right? If you're Japan, if you're China, and you've been accumulating assets, right? What share of them are in gold? What share of China's national savings are in U.S. Treasuries? Well, we know China's been reducing. That's kind of the most notable example, but other countries have been reducing over the past 3-4 months, and you can see that in the tick data. Of course, we know what's been filling the gap, which is a bunch of highly levered hedge funds, those foreign private investors. They have been kind of stepping in to fill the gap that the central banks have been leaving by stepping away from buying U.S. Treasury debt.
Now, to slow down, when you're saying accumulating, we're not talking about accumulating more debt. Most of these other countries are selling off our bonds that they had priorly been holding for a long time. And as you made the correlation there, I don't want people to miss it. You're going through so much good core, there's a lot of meat and potatoes. From 2010 on, when we seemingly printed too much, or that was 2012, when we seemingly in QE3 printed too much to show the world, hey, we're just going to keep printing into oblivion, interfering with the free trade, interfering with the free market. that's when we start to see the disconnect of them buying our bonds and now shifting over to more, let's just say, historically better storages of wealth like precious metals. But in the
Neutral.
last neutral. And in the last 3 to 4 months, as we can see that parabolic graph on the screen right now, we're seeing that squeeze just get tighter, it seems, around we need to find something other than the dollar to keep us afloat. Is that what we're seeing in gold and silver?
Yeah, so some amount of it is gold, the price going up, right? So as the price goes up, that is going to increase the value, I guess, total nominal value of foreign gold holdings. So part of it is that, but part of it is gold buying, right? Like net addition when it comes to the central banks on a net basis, adding to their existing gold position. So you can see, but both of those dynamics are at play with what's going on. And again, it's neutral, right? So in 2022, we kind of sent so 2012 we told the world, hey, we're gonna, we're not afraid to print money. That was QE3. We're not afraid to print money to buy our own debt. Right, that was
buying our
QE3.
own supply.
That was QE3 in 2012. Yeah. And then 2022 was, we defaulted on our debt. When the debt that was owed to Russia, the debt that the Russian government, right, the central bank of Russia, the debt that they held in their FX reserve, we defaulted on. And look, we didn't call it a default. We called it a FX reserve seizure, seizure of Russian FX reserve. But really, at the end of the day, it was a default on debt that Russia Russia held debt, and that debt, there was a kind of a legal obligation for the U.S. Treasury to pay Russia on that debt, right? Both a principal and an interest rate. And we basically defaulted on it. So 2022 was kind of another major turning point where we told the world, you might have been putting your savings, your national kind of savings, you might have been accumulating it in U.S. Treasuries, but you should really rethink that, right? Like, why, if your goal is to maintain the reserve currency status, why would you ever give an indication to the rest of the world that your debt cannot be trusted, right? But that's exactly what the prior administration did in 2022 when they seized FX reserves from Russia, basically defaulting on the U.S. Treasury debt that Russia held of the U.S. Treasury.
Okay, so just breaking that down a little bit, you think that we showed our cards a little bit, that maybe we're not as financially astute as we're claiming?
There's a number of key turning points that you could point to. I would also argue that, recently having interest go to 23% of tax revenue is probably
fair.
Not right. Like it's an accumulation of many, bad policies by many different administrations that have led us to the point where, the world is waking up to the fact that the dollar is maybe not as strong, as reliable, as safe as we thought it was. Well, what is more, think if those are your concerns, if your concern is, my country's accumulating, wealth or savings, I want to make sure that we store that in something that can't be seized, that is going to maintain its purchasing power. What better asset than gold, right? Gold is money. Everything else is just credit, as JP Morgan said. Gold has been money for, thousands of years,
centuries.
Yeah, and it's a bearer asset. It's scarce, relatively scarce. Now the supply can go up. You can find new supply of gold, right? If the price went to $1 million per ounce, imagine how many people, every American would go out to every river in America with a pan, right?
Back to my 49ers days, we'd be mining.
Yeah, so new supply can come online with gold, but generally, right, it is pretty scarce, and so it's going to optically go up in price as the dollar is being printed. Now, this chart is not actually showing gold today. This is showing gold through 1973.
Okay.
So of course, 1971, I'm sure your followers all know about the Nixon shock. That was 1971. Sure enough, we saw gold start to rip higher. This, right, you would look at this chart and put it next to what gold looks like today, and it looks pretty indistinguishable. So gold up here at $64 per ounce, and that would have been in June of 1972. So, many people back then were probably thinking to themselves, wow, look at this parabolic rise that gold has gone on.
Right.
It can't possibly continue. Well, let's
Right.
kind of scroll forward a little bit here and see what happened. So by the end of 1973, gold was up at 80. Oops, 120. Got
Oh,
some
wow.
pullbacks. There will be volatility throughout this.
Look at that first parabolic rise at this point. Holy cow. It looks
right.
flat now.
It looks like nothing.
Wow.
And so now gold hit a peak up 180 in 1974, and then it went up to about $200 per ounce in late 1974.
God. We're still only at $200.
Yeah, exactly. We got some volatility, right? Like there was a pullback here. Gold pulled back from $200 per ounce down to 100. That's a 50% decline.
Wow.
In the gold price. That would be equivalent to gold going to what, 1700, something like that. I'm bad with math.
Yeah, like 20, more like 2350, I think. At this
there
point.
you go.
Yeah.
There you go. And so then we kind of push the tape forward, and we are up at now $400 per ounce. Now we're up at 600, 800, right? So the point here is the last time that we had kind of a global monetary reordering, which was the Nixon shock, 1971, gold can do some pretty amazing things, right? When there is a need for global wealth to find an asset that is not seizable, that is scarce and going to go up in price as the currency base is expanded, right? As the monetary base is expanded and money is printed, you want something that's going to go up in price. Now, we've kind of shown to the world that, again, going back to 2012, we're not afraid to print money, print dollars to buy our own debt. That was 2012 QE3, totally unnecessary. Then in 2022, hey, you might have thought that you could store your country's savings in U.S. Treasuries, but we can take those if we don't like you. So, there's an accumulation. You talk about interest being 23% of tax revenue right now at about $1.2 trillion per year or $3 billion per day. The likelihood that we're going back to yield curve control, financial repression of some kind, whether or not it's total and complete yield curve control, who knows? But really the only way out of this kind of debt picture is to get the interest under control. Well, how do you do that? You cut the overnight federal funds rate way more than we really should be with inflation at 3%. And assets basically at all-time highs, screaming higher, right? Whether it's the S&P 500, whether it's gold, everything is going up into the right. Home prices, average home price nationwide. We're going to cut the federal funds rate even more, right? We shouldn't have cut the past two meetings with inflation at 3%. And again, gold, S&P 500, home prices, everything basically at all-time highs, screaming higher. We should not have really cut the past two cuts, but we're only at like 3.5%. Right? They're going to take it down significantly because the way that you cut your interest expense is to cut the overnight federal funds rate more than you should.
Right.
And then issue all of your debt in T-bills. And that's going to be very inflationary on a number of fronts. So it's going to be inflationary cutting the federal funds rate just on its own, right? Cutting the overnight rate, that is stimulatory by definition. You're reducing the price of a dollar. You're reducing the cost of money. So by doing that, that's stimulatory. But then even more stimulative and inflationary, you're going to start issuing even more of your debt in T-bills, which are very money-like. They're very cash-like.
Yeah, because you're talking a treasury bond that expires in under a year.
Yep. So that is very money-like. Issuing your debt in T-bills is much more akin to printing money than issuing your debt in 20, 30-year bonds. And a 20, 30-year bond has a lot of volatility, as we've seen over the past 5 years, right? The world is waking up to the fact that the era of kind of ZERP and QE and, 50, 60-year bond bull market, that era is over. And I would just remind folks that, whether it's Peter Turchin or Neil Howe, a lot of those structural demographic theory guys have shown that interest rates move in these kind of long lifetime cycles. Well, we just came out of a 50-year, 60-year bond bull market where rates were coming down. How much higher are they going to go before the Fed steps in and, the U.S. Treasury steps in and goes, look, we can't have the 30-year at 7-8%, right? It's probably well before that. But yeah, we are showing the world, look, we're in the bond market is showing you, we're going to cut the federal funds rate, the overnight rate, way more than we should. We've already done that, in my opinion. Then we're going to issue even more of our debt in T-bills, right? Basically money, cash market. And then we're going to financially repress the T-bill holders. And who's going to buy the T-bills? It's going to be, to some degree, the stable coin sort of thing that people are talking about, right? Like, who's going to get financially repressed? And that's a fancy term for bondholder getting wrecked, right? Like, what we need to
So
get
slow down. You're on a roll. Slow down. So to break this down back to the original question of talking, kind of gold, right? Gold's going up and precious metals are going up because trust in the dollar's going down. They're watching our volatility. They're watching our irresponsibility. And like you brought up a great point in talking about our ability to just come and seize somebody's assets, take back the bonds and treasuries or whatever. I mean, they're talking about forcing China to have to sell their real estate holdings. But though that might feel American, the foreign buyer of our debt, the foreign holder of the investments of our dollar, our debt, any form of asset of ours, has to look at that and think, is this the best long-term hold when any president who doesn't like what we do can just come in and be like, taking that?
Yeah.
I hear that.
That's what we just did, right? We went into a sovereign nation and kidnapped their president.
And an authoritarian, self-elected, shouldn't have been in charge.
Yeah, for sure.
And we're not getting into the politics of the situation, but
yeah,
I do want to switch gears because I need to know personally what the heck's going on in silver. Silver specifically seems like, okay, a couple conspiracy theories. It seems like there was some form of bank short situation gone wrong in silver about a weekend ago, toward the end of December. There were some conspiracy theories going around that there was a Fed Reserve controlled private, basically sweeping up of what could have been a bank failure. And now, on the other side of a more than $70 billion hit to the repo market, which I saw you cover the other day, talking about the reverse and the inverse of the actual repo market, we also saw continued money printing and the silver price detaching internationally. That's where it gets so confusing for me. American dollars versus silver, I think we're trading at 70 to 75 an ounce today. They're over 100. So what's going on there?
Yeah, so the green line here shows Shanghai, the price of silver in Shanghai with the Shanghai futures.
Mm-hmm.
There's a number of different ways to, you'll see on platforms like X, you'll see people in other countries posting screenshots, right? But like when it comes to like data that we can look at with a chart, the best way to illustrate is probably this green line here.
Okay.
So this shows the price of silver in Shanghai relative to the price of silver here in the US. Now, this was as much as $8, $9, $10 per ounce earlier. And
just for perspective, for those who can't see like myself, what's the date like on this graph? Like how long back is this?
So we're looking from early December onward.
Okay.
Yeah, and so up here at the peak on Christmas, it was about $8, $9 per ounce, and it's come in with the price of silver, but it's starting to move higher again. This is probably the best way to illustrate that. You can also take a look at like spot relative to futures. So generally, spot should not trade at a premium to futures. That's known as backwardation, but that is something we started to see in October, where things were getting really crazy, where spot was going way above the front month future. I haven't checked today, but I did check last week. That is not occurring. What we are seeing is, again, a premium in the East, in Shanghai, relative to what, silver here in America is trading for. And so I think that we're going to see, I don't think that silver will be the only place that we see a kind of geopolitical or geographic disconnect between prices. I think that over the next decade, we'll probably see this sort of thing into other commodities as well. As we kind of move from a globalized world into a much more multipolar sort of world. I think countries are going to focus much more on their own situation and much less on the rest of the world.
And
I think you're going to see,
by definition, nationalism, just for those listening, nationalizing.
Mercantilism, state capitalism, which, is what we here in America, we're emulating China much more than we ever did.
And people hear that and they're like, we're not communists. Like, yeah, we actually do have a lot of similar tendencies. But to your point, and I want to go back to it on a round back to it, it doesn't seem natural, normal, legal, ethical, like something economically broke. Like it seems like somebody has to be lying when it comes to silver right now. It's not connecting in my brain. And I know you dig deeper into the graphs for me. So let me just kind of ask a different way. Why is it that, like right now, I think it's in Japan, where we're well over $100 an ounce. So if I were to get on a plane and bring my silver in, I could make more on it there than I could selling it, at a pawn shop here in Delaware.
Yeah, that arbitrage opportunity will close eventually, right? Silver, it's a bit difficult, right? Because when you're talking, 100 million ounces of silver, that is pretty big and it's pretty heavy. So to close an arbitrage gap with, just take it to the extreme, to close an arbitrage gap with Bitcoin, basically instantaneous, right? You can go to an exchange. This is something that used to happen back in the day. You had BTC in, I think it was China. It was a while ago, like a decade ago. You would have like different exchanges. It was trading at different prices. This is what Sam Bankman-Fried actually kind of got his start doing at Alameda Research, or at Jane Street, was closing that gap on different exchanges in different parts of the world, right? You buy it in China and you sell it here in America at a tiny little premium. Well, enough people do that, and eventually that gap closes. And so that arbitrage opportunity was, say, something digital that doesn't, there's no need to transport. There's no weight to it. There's no real security that you got to hire to, go on the plane to make sure no one steals, right? There's none of that. It's just go into this brokerage account here in China, then buy it, transfer, boom, sell in the U.S.
So as that arbitrage window shuts down, though, sorry not to interrupt you, as that arbitrage window shuts down, where do we end up kind of meeting at? Are we lagging behind some of these price points right now? Do we see, because I see people in the comments right now, don't buy at all-time highs. Don't buy at all-time highs. And we were talking about accumulating precious metal the other day, and you said you were even cautious to invest at all-time highs. But just going back to that graph you showed on gold at the beginning, the constant, wow, that's parabolic. Oh my gosh, look at that. And now you get up to today, and you can't even see the movement. But at that point, it looked parabolic. So what's the answer here? Are we lagging behind?
I think so. Yeah, I think
So with that answer, because I know you can go in a million different ways with that. Why then are we at $70? That seems like fraud. That seems like we are we are maneuvering and manipulating our market internally to give a different perception than what is true. If other countries are seeing such a, like you said, the arbitrage between the two are vast. And we saw 70 billion getting hit from the repo facility. And we saw this rumor of a bank crash. And it's around silver. And JP Morgan and Bank of America are like two of the biggest silver shorters. So I'm not trying to wear the tinfoil hat. I wear a full tinfoil outfit. What is going on here?
Yeah, we did. So the repo, this is where there's a shortage of liquidity and banks or financial firms have to go to the Fed, and the bank, I will pledge $10 billion of US Treasuries and the Fed will loan me $10 billion, actual US dollars. That is the standing repo, the SRF. And we saw on the 31st, a huge amount, like $70 billion get tapped almost from the standing repo, indicating, a shortage of cash. Well, the problem was the reverse repo at the end of the month here, at the end of the year as well, was 105 billion. Now, the reverse repo is the exact opposite. That is where the banks have too much cash and they're trying to park it overnight, right? They get a tiny amount of interest, they go park it at the Fed. So you have to look at them relative to one another. If you just looked at the standing repo, you would have seen that spike of, $74 billion and thought to yourself, oh, there is a huge shortage of cash in the plumbing of the financial system. But once you look at the reverse repo, which is 105 billion, there was actually, once you take the difference between those two, there was actually an abundance of capital. It was actually the next day that we actually saw a shortage, when, again, looking at them relative to one another.
Yeah,
it wasn't until
but we're looking
January.
day by day at this point on an account that wasn't even getting utilized September?
June, July 2020 was really the last time that we saw. And the standing repo used to be a discretionary tool. It didn't always be it wasn't always the standing repo, right? It was a open market tool that the Fed would use on occasion. When it became standing, we are hitting all-time highs from the time that it became a permanent fixture of monetary policy here in the U.S. So there's always a liquidity squeeze or shortage at the end of the quarter, at the end of the year, especially. And so, it's definitely worth keeping an eye on whether or not it's linked completely to what we're seeing in silver. I think, it's possible. I try not to ever say that something is impossible, but I'm not sure. I mean, I would show this, which is when you look at the secured overnight financing rate, which is the overnight cost of capital, the actual overnight cost of capital. When you look at that relative to what the Fed is trying to set in terms of the overnight cost of capital, and you look at gold relative to that, there is actually a pretty striking correlation there. So gold broke out of that $2,000 range right as SOFR started to become elevated, indicating, again, what SOFR is showing you is the degree to which there's a liquidity shortage in the plumbing of the financial system.
Yeah, the SOFR account gets utilized when they need quick cash. So when we are low in liquidity, that rate can typically go up because when there's less cash, you can charge more for it if you have it.
Yeah, if you're the only firm on Wall Street that's got cash, you can charge a higher price. And the price of money is the interest rate. So
the white here is that interest rate, and then the green is gold?
Yeah, the white is a 9-day moving average of the difference between what the market is telling you the liquidity condition is. The difference between that interest rate, SOFR, and what the Fed would like it to be, that difference is in white, 9-day moving average, because there's a ton of volatility. So that's in white, and then green is gold. So gold, for those like me that have been invested for a while, you might recall that gold would go up to 2,000 and it would pull back. Go up to 2,000 and it would pull back. The breakout in gold above that $2,000 level happened here in kind of March, April
of 2024. Well, sure enough, that is kind of exactly when SOFR started to become more elevated. And
yeah, you can at least see the volatility there. Yeah.
Well, if you look at that second
huge breakout in gold from
Yep.
3,300 up to 4,000. That coincided almost perfectly with SOFR starting to widen. Now, whether or not that's just a correlation, right, and it's not causative, I'm not sure. I would argue that again, whether I think the story here is whether it's a sovereign nation like China, like Japan, whoever, and is looking at the options that they have to store their country's excess savings and going, well, yeah, the U.S. is not exactly, they pretty much the only way for the U.S. to get out of their fiscal situation of, these huge eye-watering deficits, huge amount of interest expense. The only way for them to do that is to force bondholders to suffer real losses in real purchasing power terms. The value of their U.S. Treasury debt must go down, just mathematically. That's the only way that we can get out of this. They in 2022 they seized another country's U.S. Treasury debt or defaulted on it. Whether it's a sovereign nation looking at that kind of omelet, smorgasbord of options, right, in the global scheme of things, or whether it's a financial firm that is looking at increasing liquidity strain. And some amount of this, look, like people have made the point on my videos, there's not, just because SOFR RRP or SOFR IORB, just because these spreads are going wider, right, indicating that SOFR is becoming more elevated above what the Fed would like overnight interest rates to be, does not mean inherently that there's a shortage of liquidity. It just means there's a shortage of liquidity that is willing and able to be lent out in the financial system.
Yeah, good
if
distinction.
If you're a bank and you're worried about loaning out cash overnight in the repo market, if you're worried about counterparty risk, you're going to hesitate on loaning out your cash. You might have 50 billion, 100 billion, whatever. You might have it, right, in cash and liquid US dollars. But if you're worried about counterparty risk, you're going to pull back from going out and loaning it out into the market. And that, effectively is going to have the same effect as if there was just an outright or absolute liquidity shortage. What better instrument than gold? Again, gold has no counterparty risk. Gold, you hold it in your hand, you are the owner of that gold. It's a bearer asset. So you would expect, some amount of correlation where if banks are starting to get worried about counterparty risk, if they're increasing kind of concerns about broader liquidity conditions, you would expect to some degree that gold might be held. Now, gold can also get sold off, right? Like if we go into a recession, there's the financial side, the paper side, the speculative side. Gold and silver can absolutely get sold in a flash crash, VAR shock sort of environment, where the S&P 500 is crashing 2% a day. People are getting margin called, right? You sell what you can, not what you want to. So I would, my outlook is to expect more volatility, and I'm willing, and I'm readying cash to buy dips in assets that like gold that I want to own, because I think that there will be increasing amount of volatility over the next decade. I think that just like we saw going back with the gold chart, right there, gold had a 50% pullback in the midst of that run from $30 to 800. It had a 50% pullback in there. It had a couple 10, 20, 30% pullbacks. So I think that there's going to be a lot of volatility. It's not going to go up in a straight line. I think that much is pretty clear. But look, the liquidity side, you have two sides of that coin. On the one hand, when counterparty risk is a concern, like we're kind of looking at here, and SOFR spreads are widening, indicating that maybe firms are pulling back from lending out the cash they might have because they might be concerned about counterparty risk. Well, gold could do well in that environment, but generally, gold is kind of liquidity sensitive, right? It's trying to sniff out liquidity conditions over the next 1 year, 2 years.
Right, they're trying to price it in, predict it.
Before, markets are forward looking.
So putting as we come up over an hour, I want to kind of put a bow on our conversation a bit. There's no guarantee it's not going to move up in a straight line, but in large part, when there's lack of trust in our dollar, less belief that our debt will ever be taken seriously and nevertheless taken care of, and we see more nationalization happening across the world. And even ourselves walking into another country, getting away from the politics of it, we walk into another country and we say, hey, you have a lot of oil, you have a lot of gold, you got a lot of reserve. They're ours now. Like, that is a worry. You bring up 2022. We did the same thing with Russia. That is a worry for a foreign holder of any form of asset of ours, that if we just tick them off, they can be like, never mind, and you just lose it. It's like a drug dealer getting pulled over. He's like, why are you taking my $200? He's like, because you used it for drugs. I always thought you couldn't prove that. I was always like, why are you allowed to do that? But regardless, that's what we're doing. And so that lack of trust leads to, let's move toward maybe more precious metals. Let's move closer into better stores of wealth outside the dollar. And it's not going to move like a hockey stick, but over time, that seems to be the recipe that's been cooked up since '08.
Yeah, it's not a new phenomenon, right? Like, all of a sudden people are talking about the debasement trade and de-dollarization and all that, but like, this has been going on, right? Well, I showed the foreign held debt as a share of total government debt. That peaked 13 years ago and has been declining for 13 years. If you look at the IMF data on dollar share of FX reserve, that peaked 13, 14, 15 years ago. So, and has been declining ever since. So this is not like a new phenomenon. And I would also point out, it's not isolated to the US. So here we're looking at the German 30-year yield, the French 30-year government bond yield, the British 30-year government bond yield, the Japanese 30-year government bond yield.
And why are these all going up at the same time? Like, where's the money going if all of the major economies are seeing... Well, I suppose that the money can still be going to those because the investors want the higher yield. But why are they all going up simultaneously? It seems like there should be some balance.
Well, because it's not just the U.S. that is in a fiscal pickle, right?
The old fiscal pickle.
Yeah, this is not just a U.S. story. And so I think that's always important to point out. This is, an issue. You look at Japan, right? Debt to GDP of like 240%. Far worse than the U.S., but they're a current account surplus country, and they have very minimal external debt. So it's not a one-to-one. It's kind of apples to oranges with Japan. But you look at like Great Britain, they're arguably already in a debt crisis. France, arguably already in a debt crisis. Germany,
yeah, I
not
was
as
talking
much,
with an economist from
but
London the other day, and he said we're pretty much just in a recession. They won't admit it, but they are.
Oh, they're horrible. In the UK, they have inflation at like 4% and growth of like 0. Right?
Yeah.
Talk about stagflation. Their tax revenue as a share of GDP has been declining for the past 3 quarters, I think, which is not good when you're trying to tax your way out of a fiscal situation. So it's not just a U.S. story, right? Whether it be the German 30-year Bund yield, or the French 30-year OAT yield, or the U.S. 30-year bond, Treasury bond yield. All of those instruments are centralized, right? They are all, you're taking some amount of counterparty risk, right? Counterparty risk didn't really, you didn't really have counterparty risk on the sovereign scale for the past, couple decades at least, right? In globalization, everyone is just cooperating all the time, and we have each other's best interests at heart, and you never have to worry about things like a government defaulting on legally obligated debt. You never had to worry about that, right? But as the world moves away from that kind of peak globalization and much more into a multipolar, nationalistic, every country focusing on their own needs, you can call it mercantilist sort of world. Once you move into that world, it's not just the U.S. Treasury yield, the U.S. Treasury market that becomes kind of risky. It's not just the Treasury market. It's any sovereign debt, right? And so that's why we're seeing, the British 30-year gilt yield up and to the right, French, German, Japanese, all of them are going up and to the right. And just to remind folks that the bond price is inverse to the yield. So when you have the long end of the yield curve going up and to the right, the price of the bond is going down and to the right. So
yeah, and to put that in TLT English, because I feel I heard that in the last. I feel I heard that like for 2 years before I understood what it meant. It just, if an investor sees a higher value in an investment, they require a lower ROI. And as the value of it is going down, they're requiring a higher ROI, and that's that higher yield, correct?
Yeah, so like, people know TLT is kind of a common bond ETF. That's going to be the white line, right? Which is the 30-year government bond yield. You just invert it and it's TLT. So for folks that are familiar with TLT, that's you're buying the bond. Now, look, as long as you hold a bond to maturity, you're going to get your yield, you're going to get your principal back. I'm not saying that the U.S. is going to default in nominal terms on its debt. What I'm saying is that very similar to after World War II, the math was such, we had debt to GDP above 110%. The math was such that the bondholders had to suffer losses. In real purchasing power terms, they had to suffer losses. Now, we still paid, if you put $100 into a bond in, the 1940s, you still got your $100 back at the end of the term, right? 10 years or whatever it was. You still got your principal back. You still got your interest rate of, I think it was 2% for the long end that they capped it. But the problem was your 100, say, let's use a 1-year bond as an example. You put in $100 into a 1-year government bond. There's a 1% interest rate. You're going to get your $100 back in 1 year. You're going to get your $1 of interest for the 1% interest rate. The problem is that what they're going to do is they're going to run inflation at 10%. I'm just using simple numbers. So now your $101, well, if the groceries went up by more, right? The car insurance went up by more. Real actual goods and services, inflation, the basket of inflationary goods that they measure, that is going to have to go up faster than the interest on the debt would dictate. So you suffer, the bondholder, to take a real loss, a real purchasing power loss. They didn't take a nominal loss, right? They got their $101 back at the end of the 1 year. The problem is that, if inflation was 20%, now it takes $120.
Correct. They lost money,
power.
in nominal terms.
And so I think that that's not just true here in the U.S. Japan, right, has been engaged in yield curve control and QE, and they're kind of coming out of that. But the developed world is very indebted, and so I think that as the bond market wakes up to the math of the fiscal reality of not just the U.S., but France, Great Britain, Japan, right, go down the list. As the bond market wakes up to that, they're going to demand a higher premium, right? If you can look back to World War II, following World War II, where we last did this kind of financial repression, inflation was like 18-19% at the peak. And bond yields were capped by the Fed at like 1 or 2%. So yeah, if you bought bonds, you suffered a 16% loss per year. Inflation peaked at 18%, didn't continue there. But that I think is what the bond market is waking up to, and therefore it's demanding a higher interest rate, right? Sure, I'll loan you money for 30 years, but 30 years is a long time, right? You're not in the best health when it comes to your fiscal situation. We know the last time you got pretty indebted, we know what you did, right? Yield curve control, capped rates, ran it really hot, 18-19% inflation, and I think 5% real GDP growth. So, we're going to demand an ever increasing premium or yield interest rate cost to loaning you money for long periods of time. What they're going to do that I think will be different this time around is they're going to try to target the short-term T-bill holders, rather than trying to financially repress the long end, which was never going to work. They're going to try to do it where the demand is, which is at the short end of the yield curve in the cash market, 1-month bills, 3-month bills. Because look, if you're a corporation here in America, you have operational expenses, you're trying to plan for an acquisition, you have cash, right? There's always going to be a demand for cash for the US dollar. That demand is still pretty strong, regardless of all the kind of de-dollarization, that angle to it. The demand for very, very short-term US dollars, in the form of T-bills, is always going to be pretty high, at least for the next decade. So what they're going to do is they're going to cut the federal funds rate very low, which is what T-bills just follow the federal funds rate. They're going to cut that interest rate very low. It's going to be stimulative. It's going to be inflationary, and they're going to financially repress the T-bill holders, right? So if a 1-year T-bill offers 1% interest, but inflation is 3 or 4 or 5 or 6, you're getting out of your kind of debt and fiscal situation, at the expense of people that are buying your T-bills, and that could be stable coins, that could be. The bond market's waking up to that reality, demanding higher premium, and you feed into that kind of the de-dollarization. Gold becomes very appealing in all of this, right? Everything that I've just talked about, whether the repo market and kind of what was starting to emerge there, with liquidity stress and counterparty risk, whether it's sovereign risk that the risk that we have shown to the world back in 2022 with the seizure of FX reserves, and an kind of increasing or decreasing globalization, increasing nationalism all around the world. Whether it's fiscal reality, right, where all these governments are going to have to print a lot of money. All of these things are very bullish for gold. Like, I don't really see a bearish catalyst for gold. I would just, I can't give recommendations, but the way I'm approaching it is not to use leverage, because if you're levered, that 50% pullback could wipe you out. A 10% pullback could wipe you out, right? So I'm staying like unlevered. I think that's key. Because if you look, for example, I don't think we're going to hyperinflation, but if you look at the German hyperinflation, the price of gold in what was the currency? Not Marks.
Oh yeah, Marks, German.
Marks. In Marks, in the native currency, the price of gold was, there was like 50-60% pullbacks every couple months, right? Like, there's a huge amount of volatility in these sort of kind of fork turning sort of environments. So staying unlevered, I think, is important. And just kind of, again, I don't really see the bearish catalyst for gold. But there's always the potential that something, some black swan emerges out of nowhere. We get a huge VAR shock where everything just gets sold because everything's crashing,
because we don't have a magic crystal ball to know what's going to happen in the future or what could come out of left field. It's always the bus you don't see coming that kills you, right?
Yeah, but like, the zooming way out and looking at everything, it's all pretty bullish for gold and silver, in my opinion. Now, silver,
I agree.
Is 50% industrial, right? So I think silver could benefit from kind of the global growth reacceleration that I think, if I had to pick, either are we going into recession or are we reaccelerating, I kind of lean more in the reacceleration camp. Well, if we're going into kind of a run it hot global setup where everyone around the world is running it hot, silver could do very well, right? Because 50% of silver demand is for industrial purposes. That would obviously increase in a kind of global growth reacceleration. So silver could benefit kind of on both directions. But yeah, I'm very, for the next like decade, 2 decades, I'm very bullish gold. There can be those 50% pullbacks, but again, I struggle to find the bearish catalyst for gold.
The only thing I need to find right now, brother, is the brand of coffee you drank before this call, because you are on.
Oh man, I'm so tired.
You're on one right now, brother. You're on fire. Okay, so I just want to summarize. We do this every single week. This is our economic update. We do it at 11 a.m. Eastern. This is Robert from Infranomics. Feel I didn't get the opportunity to let people know where they can follow you. YouTube, X. You are a fantastic follow on both. And the simple message here, as I got to wrap up, I got to get back to my daughter upstairs. She's yelling at me via text, is a few things. One, the math seems obvious that inflation is in front of us. The opposite of inflation, barring going neutral, is deflation, and we do not want that either, just to run that counter argument. So if we know inflation is in front of us, holding physical assets, people would point to things like Bitcoin and crypto, physical gold and silver, ETFs and indexes across the stock market as we seemingly pump more and more money into our ecosystem, into our monetary base. That is the core ingredient of inflation. And we're seeing some of that stress mathematically in the bond market, And it's not just our bonds. It's everybody's bonds. We're seeing the stress, we're seeing the signals, and we're seeing the Fed, as you have the graph pulled up, seemingly lose a bit of that control of what they once had in the bond market. And dude, where can people follow you? I don't have time for another graph. I got to get back upstairs. We could do this all day. We should do like a streamathon and just do this all day and go back and forth with questions from the crew. But dude, where can people follow you so they can learn more from you?
Yeah, I got a YouTube, Infranomics, INFRA nomics, like economics. I'm on X. I'm on obviously Instagram. I think those are the main ones.
No OnlyFans?
Yeah. No.
Shit.
No.
I think there's a room for like nerdy OnlyFans though. I think there's a niche there.
I do have Threads and I do have Reddit. I don't really use them.
Dollar General
those
Twitter.
were the ones I was trying to remember. Yeah.
Nice.
Mainly I'm on X. Mainly I'm on X and YouTube.
Perfect. Well, brother, we will be back here next week, 11 a.m. Eastern. We'll try to keep it under 45 minutes to an hour, but if you give my boy Robert a cup of coffee, he's on it. So we'll be touching more as we go into whatever the heck's going on with silver. We'll continue to track the bond markets. And dude, anything you want to end on?
This is the first time the Fed's been cutting rates and the long end, right? The 10-year yield and the 30-year yield have gone up. It's not normal. And so, yeah, I very, very bullish gold for the next like 10, 20 years.
Heck yeah.
And I would also just say crypto and Bitcoin are not analogous, right? Like in my opinion, the vast majority of the crypto world is worthless. So just, if you're venturing into those waters, just be wary that there are significant differences between fart coin and Bitcoin or something like that.
And whatever the CIA built, Bitcoin, I don't know. Could be a giant systematic rug pull. I don't know.
No, that would be bullish if they did.
Okay, then we're gonna have a whole other conversation. Then we can't keep going on that because that's an interesting one. But dude, please go follow Robert wherever he is. You should follow him also. Love you guys. We'll continue to keep track of everything that is economy. Have a great one, y'all.